All right, welcome to This Explainer. Today, we're tearing down the structural blueprint of professional portfolio management. I want you to think about investing not as some random game of chance, but literally like building a house. You wouldn't just dump a bunch of wood, concrete, and nails into a pile in your yard and expect it to magically survive a Category 5 hurricane, right? Well, maybe if you're building a modern art installation, sure. But for the rest of us, protecting our wealth requires a rock-solid foundation, actual load-bearing supports, and a very deliberate architectural plan. And that is exactly what we're going to do with your capital today. To really get this right, we have to completely rewire how we think about financial markets. The amateur mindset is almost always obsessed with one specific, basically impossible question. Which asset is going to go up? But the pros, they're asking something entirely different. They're asking, which combination of assets provides the appropriate risk-return relationship across a bunch of totally unpredictable scenarios? So we are officially shifting away from the impossible task of guessing tomorrow's winning stocks and moving into the highly practical science of engineering a resilient, weatherproof asset combination, one that survives no matter which way the macroeconomic winds are blowing. Okay, let's dive right into this. We've got 5 key areas on the agenda today. First, the true goal of investing. Second, redefining risk and volatility. Third, the building blocks of portfolios. Fourth, advanced tools and strategies. And finally, 10 principles of portfolio management.
Section 1, the true goal of investing.
Before we can even pour the concrete for our portfolio's foundation, we have to draw a really hard line in the sand between investing and speculation. Investing is all about allocating your current resources for future benefits. We're talking long-term capital appreciation or generating reliable cash flows over time. Speculation, on the other hand, is heavily focused on exploiting short-term price movements. But here's the truly fascinating part about this. The boundary between those two things isn't the asset itself. Think about it. The exact same S&P 500 index fund can be held for 30 years by a true investor who is patiently compounding wealth, or it can be panic sold after just 3 days by a speculator who's trying to time a noisy news cycle. The difference isn't the ticker symbol you bought. The difference is entirely in your time horizon, your decision-making framework, and your own personal risk tolerance.
Moving on to Section 2, redefining risk and volatility.
Now, let's check the structural integrity of this house we're building. We need to completely dismantle a massive myth that catches even seasoned market veterans off guard. Financial risk is not just volatility alone. Volatility is basically just measuring the statistical dispersion of historical returns. It just tells you how much a price bounces around on a chart. True risk is so much broader and, frankly, much more dangerous. You could easily hold a portfolio that has pretty moderate statistical volatility, but it might secretly be massively exposed to credit defaults, or inflation just silently eating away at its purchasing power. Just think back to 2008. So many supposedly low volatility assets suddenly had literally zero liquidity. You couldn't sell them at any price. That is true financial risk, and just staring at a volatility metric is never, ever going to warn you about it. You absolutely have to measure risk by looking at the actual permanent damage a portfolio can take, and that brings us to maximum drawdown. This is simply the measure of a portfolio's decline from a previous peak to its subsequent low. So a drop from 100 grand down to 70 grand, that's a negative 30% drawdown. Now, why is this absolutely crucial for you to understand? Because the math of breaking even is just brutal. If your portfolio drops 30%, a 30% gain does not get you back to where you started. Because you are now trying to compound from a much smaller base, you actually need a 43% gain just to claw your way back to break even. Two assets can have the exact same annualized volatility on paper, but wildly different peak-to-trough drawdowns in the real world. You have to know exactly how deep that valley goes before you even think about adding an asset to your portfolio. Section 3, the building blocks of portfolios. So, with our foundation poured and our structural integrity fully defined, what are the actual building materials we're using? Imagine a hypothetical strategic asset allocation broken down like this: 50% stocks, 30% fixed income, 10% commodities, and 10% cash. Now, this isn't some universal one-size-fits-all recommendation, but it brilliantly illustrates how these different pieces interact to keep the house standing. You've got your stocks doing the heavy lifting for long-term growth and outpacing inflation. You've got fixed income acting as ballast to provide steady yield and cushion the blow when equities inevitably drop. You throw in commodities because they act as a totally distinct inflation hedge. They respond to very different macroeconomic drivers than corporate earnings do. And crucially, that 10% in cash, that is not just dead money sitting around. It's a highly active position. It is the dry powder that guarantees you have the liquidity to swoop in and buy incredible opportunities when everyone else is panic selling. But look, you don't just lock these weights in a vault and forget them forever.
There is a vital difference between strategic and tactical asset allocation. Your strategic allocation establishes your long-term, stable structure. It's your ultimate baseline for risk. Tactical allocation, though, means temporarily tweaking those weights to capture specific short-term market conditions. But let me be crystal clear here. Tactical allocation is a scalpel. It is not a sledgehammer. It is absolutely not a hall pass for undisciplined speculation. A true professional tactical strategy demands incredibly strict entry criteria, pre-planned exit rules, and a mechanical trigger designed to automatically revert you right back to your strategic baseline. Section 4. Advanced Tools and Strategies.
Let's get into the advanced engineering of our portfolio house, starting with a core concept from modern portfolio theory, Harry Markowitz's efficient frontier. You've probably heard people on Wall Street say that diversification is the only free lunch in finance. Well, this is the exact math that proves it. Markowitz won a Nobel Prize for his work on covariance, which is really just measuring how two different assets move in relation to each other. In plain English, if asset A zigs, you want an asset B that zags. He mathematically proved that adding a highly volatile asset to your portfolio can actually reduce your total overall risk, as long as that new asset behaves completely differently from the rest of the stuff you already own. Now, when we engineer the fixed income portion of the portfolio, understanding duration is absolutely critical. Duration is essentially a first-order approximation that measures how sensitive a bond's price is to changes in interest rates. I like to think of duration as a giant financial seesaw. When interest rates rise out there in the broader economy, the prices of existing bonds just have to fall. And here's the massive takeaway. A higher or longer duration means a much steeper, way more dramatic drop in your bond's price for any given shift in rates. But here's the thing. That financial seesaw isn't a rigid, perfectly straight line. It actually bends. And that brings us to convexity. To keep our house metaphor going, think of convexity as the heavy-duty shock absorbers built right into your concrete foundation. While duration is a fantastic estimate for relatively small shifts in interest rates, convexity is the necessary second-order refinement. It measures the complex, nonlinear relationship between bond prices and yields. So, when the economy gets hit with massive, extreme interest rate shocks, convexity provides the math you need to understand exactly how those shock absorbers are going to behave under immense pressure.
So how do we practically apply all this? We use a brilliant engineering tool called a ladder strategy. Instead of buying a bunch of bonds that all mature at the exact same time, you deliberately spread your investments across successive years. You buy bonds maturing in year 1, year 2, year 3, and so on. This basically creates a perpetual motion machine for your portfolio. When year 1 matures, you get your cash back, and you immediately reinvest it at the very back end of the ladder. This automatically manages your liquidity and heavily mitigates reinvestment risk, basically making sure you are never totally locked into a terrible interest rate environment.
Finally, for our advanced toolkit, we really need to demystify commodities because, man, this is an area where everyday investors just constantly get burned. You might go out and buy a commodity ETF thinking you're tracking the price of physical oil or wheat, but you aren't actually buying barrels of oil. You are buying futures contracts, and that means you are forced to contend with contango and backwardation. These terms describe the physical shape of the futures market curve. Because funds have to constantly roll expiring, cheaper, near-term contracts into more expensive, longer-dated ones during contango, they literally bleed yield. The staggering takeaway here is that you can buy an oil ETF, watch the spot price of physical oil go up on the news, and still actually lose money because of the cost of rolling those contracts. This is a massive structural risk you absolutely have to understand before jumping in.
Section 5. 10 Principles of Portfolio Management.
Okay, we've covered a ton of heavy, dense academic theory today. Take a breath. Let's distill all that complex engineering down to a 10-point ultimate maintenance guide for your portfolio. These are highly actionable principles you can take and apply right now.
Here are the first 5. Principle 1. Define the objective first, before you even look at an asset. 2. Define your exact investment horizon. 3. Determine your loss capacity. And let's actually pause on that one for a second, because everybody thinks they have a massive capacity for loss, right up until the market actually crashes and the panic sets in. You have to be brutally honest with yourself about your pain threshold. Moving on. Principle 4. Diversify across asset classes. And 5. Diversify within each class. Notice the deliberate order of operations here. Your personal goals, your timeline, and your emotional capacity for taking a hit must dictate the asset selection, never ever the other way around.
The final 5 principles all share one incredibly powerful theme: ruthless discipline. Principles 6 through 10 are a constant reminder to explicitly control concentration, tightly budget for your real-world liquidity needs so you aren't suddenly forced to sell at the absolute bottom, relentlessly control transaction costs, rebalance systematically, and never, ever use complex financial instruments without fully understanding their underlying risks. Mastering mundane things like hidden fees and sticking to a cold, systematic rebalancing schedule instead of giving into panic or greed, those are the real professional secrets to long-term survival and multi-generational wealth. And that brings us to the ultimate question you have to ask yourself right now. Does your current combination of assets truly match your real risk tolerance, your specific liquidity needs, and your actual time horizon? If a massive financial storm hit tomorrow, would your portfolio protect you, or would the roof just cave right in? Take a hard, honest look at your own blueprint. Are you just collecting random assets hoping they go up, or are you actually building a resilient house? Thanks for joining this explainer, and we'll see you next time as we continue to decode the financial markets.